Now, for those still watching, I want to give you a quick gem so that you can actually predict when the buying will occur and be able to get in to target these highs. What's up everyone, and welcome to today's video, where in this one we're going to be going over what a market maker model is, the two types of them, and how to actually engage with them to give you the best possible entry in a larger move. Now let's actually start by going over a market maker sell model example. So we start on the left side of the curve. Down here we have an original consolidation, and then a leg up into accumulation, and then a smart money reversal, which is above an old high or at a PD array. The smart money reversal occurs, we get a leg down, distribution phase 1, and then the second distribution, which will then run quickly down below the original consolidation, which takes out the sell stops below here and any buy stop losses from earlier. Now taking a look at the opposite model, which is a market maker buy model. We have again our original consolidation here before a leg lower, then accumulation of what? Retail sellers who are selling from here. Then we trade into either a liquidity pool again or a PD array with higher time frame bias in mind. Have our smart money reversal, a leg up, and then distribution phase 1, distribution phase 2, and then another leg above the original consolidation here, clearing out all the early sellers and triggering buy stops above these accumulation phases. Now this will actually be quite a more advanced market maker model video, so if you aren't familiar with any of the basic ICT concepts, do head over to his YouTube channel and check out any of them, or you can find a few basic concept videos on mine. Firstly, I wanted to go over something called time frame alignment, which, as you can see, I've made a list here of the pattern in quotation marks, as we do identify them as patterns. Like, you will spot the pattern. However, what we're trading is much deeper than a pattern, and there's much more logic behind it rather than just a simple pattern like this. So I've put pattern in quotation marks, and then the time frame on which the market maker model will form based on what time frame you see the pattern appear on. So as you can see here, I'll point out this for you. We have a daily fair value gap or order block up here, which is traded into, and then we have lows left in the direction of our order flow. So this would be a technically pattern. As we trade into it and then head below these lows, this is our pattern. On a smaller time frame, this will be a market maker model. So this is what I'm referring to by time frame alignment. As you can see, we're on the daily time frame. So if you look over here, we have a daily pattern, which equals an hourly market maker model. In this case, it will be a market maker sell model. So quickly going over them: a monthly pattern, daily market maker model, weekly, 4-hour market maker model. A daily one, as I've shown here, is an hourly market maker model. H4 pattern, which is the 4-hour chart, is a 15-minute market maker model. Hourly, 5-minute, and then the 15-minute can be a 1-minute market maker model. So these concepts are fractal, the same way price is fractal. As we dive into some of these market maker models, you will see how we can actually trade a smaller market maker model within the larger one. So I will dive into an example of these now. So as you can see here, I've marked up a 4-hour example of a market maker model. But before we dive into this, I need to go over the 3 distribution phases on the market maker models. So the first phase is the low risk sell, which is the phase after a smart money reversal. Smart money reversal occurs, and then we have a low risk sell. Then the first distribution as we trade back up, and then the second distribution, which is the one I mentioned earlier as to the highest probability, and also which runs to your take profit the fastest. This second distribution should clear out the original consolidation on the other side of the curve. So dropping down into this market maker model here on the 15-minute. Why the 15-minute? Because we have the pattern on the 4-hour chart. So then drop down to a 15-minute chart and you will see the market maker model visualize itself. So if we look at the smart money reversal up here, we trade into the 4-hour gap. If we shoot above it just a bit, that's fine. Our market maker model is still valid. As you can see, let's first take a look at the buy side of the curve. We have an original consolidation here, and our consolidation is the start of every move. Then we have accumulation, a return to consolidation. Ideally, in a market maker model, you want to see a return to consolidation first, then more accumulation up here, accumulation before reaching the peak of the market maker model. Now, it's called a smart money reversal, as usually the reversal occurs above buy stops or at a PD array, which is where smart money get involved. So the reversal begins to happen. If we zoom into this price action up here, look, we create a low, a high, and then break lower past the low. We then trade into this fair value gap inside here on the 15-minute. Now we have our smart money reversal up here, trade below, and then give it a sell. This is our low risk sell. The low risk sell is actually the most highest risk entry, despite the name, and I will dive deeper into that in a second. But as you can see here, it also presents itself as the 2022 model, if you are familiar with that. Our low risk sell is the first sell in a market maker sell model. Then we break lower, and if you check what we have in this area here, this PD array is a rebalance redelivered. So now we take the top of this, stretch it out in time, and then that there. And as you can see, we tap into it here, which can be your sell, but then we hover around a bit. As you can see, this price action here, there's not much momentum to it. We hover around before spiking up into the PD array, which gives our second sell. This can be our sell, but it's the exact same PD array used here, so we count the latest sell as our second one. So this is our first distribution. One of the phases I went over earlier, our first distribution occurs after the low risk sell. We trade into this PD array and then run lower. Now, since we've traded above highs, we can say this market maker model is high probability, as we always want to be tagging short-term highs in sell programs. Short-term highs have been traded through, gives our first distribution, and now we are looking for that second distribution which I spoke about. Now this one should be the fastest entry and the fastest exit, as we should run below the original consolidation on the buy side of the curve pretty quickly. We trade massively lower, and then as you can see in here, there's that same PD array I spoke about up here where we deliver sell side, buy side, and then sell side again. This occurs here in this candle on 5:30 on the 2nd of October, deliver sell side, buy side, and then sell side again in the next candle, which is why price doesn't come up into these fair value gaps up here or any higher into this order block breaker. None of that needs to be mitigated because we have this PD array traded into. Now, the second distribution phase, which I spoke about, should be this right here. So taking this sell here with your stop, you could put it above the fair value gaps just in case, and then to take profit, I would go for a 1 to 3. However, you could aim for the original consolidation, as this is where sell stops are lying and any early buyers stop losses. So if we stretch that out in time, as you can see, we had low risk sell, distribution phase 1, and then distribution phase 2, which you can see here instantly ran straight down to the original consolidation. Remember I spoke about short-term highs being tagged in market maker sell models, as this is tricking retail into buying. If retail see a spike like this, they assume that we are going to clear out these up here. However, we are obviously inside a larger formation of the market maker sell model. Second distribution phase is always the best entry and you won't be sat in the trade very long. These can be hard to spot, but over time you will naturally just get better at it. Now, before I give you a daily pattern down to a 1 hour market maker sell model example, I just want to explain briefly how to actually predict these occurring. So how can we predict a market maker sell model occurring? If we trade into a PD array and we have bearish order flow, we can expect this market maker pattern to actually form. And then of course we drop down onto the time frame which is aligned with that pattern and then trade the market maker model. We can also anticipate it when we tag short-term highs in bearish order flow and then to trade to the lower liquidity. Of course, on the 1 hour time frame, since we're on the daily, this down here is an original consolidation and we tag a short-term high whilst in massively bearish order flow, as you can see here. Tag the short-term high and then this pattern becomes our market maker sell model from here up to here and back down to the original consolidation. So down to the 1 hour chart, if we head over here, as you can see, this is the continuation purge we spoke about, bearish order flow on the daily time frame. When we trade above this high, all this above our high becomes the smart money reversal. So smart money are selling short up here as retail are going long, because what do they see? They see a breakout above this high, retail go long, and then of course they're going to get stopped out as we move below these areas of liquidity. So if we head down and actually look for the different distribution phases, as you can see here, the smart money reversal occurred and then we trade lower before coming back into this, which is an order block. We come into about the OTE of this order block, which is our what? This becomes our low risk sell, as it is the first valid sell entry for smart money. That becomes our low risk sell up there. And then we trade lower. If we zoom into this, trade lower past the low and then leave a what inside here between these three candles. As you can see, we have a fair value gap. So then we trade into the fair value gap, give an IO Fed entry and quickly run lower. That is our first distribution. Remember, smart money reversal up here above the high and then low risk sell, distribution phase 1. And what we get over here is our second stage of distribution. If you pause the video, I want to see if you can actually point out the second stage of distribution around here. I'll give you a few seconds to pause. Okay, that should be good. Now we have our original consolidation, of course, down here, which I will mark up with a green box. Now, if we look in between here, we have a fair value gap and also inside a breaker formation. So we have the fair value gap inside a breaker formation. Why can we anticipate this one to hold? Because of that breaker. Up here we have high, low, high, high, and then lower, low. So our fair value gap inside this formation, we can anticipate to hold. And remember, we're now looking for the second stage of distribution. This can be your sell. We don't want it to return above this fair value gap at least. Why? Because of our breaker. And then you can target these lows at the original consolidation or the very terminus of the move. Terminus of the move would be a 1 to 4. However, I don't like to go for them targets. I would like to target this rejection block here. And that would be a nice 1 to 3. Look how quickly, especially on the second tap of it, look how quickly we run the original consolidation lows. Remember I said on the second stage of distribution, how quickly we want to see price run to these lows, and that is exactly what we do here. Why is this a valid second distribution entry? Because we have tagged short-term highs. Remember, for the second distribution to be valid and for it to run quickly to your take profit, we want to be tagging short-term highs in the market maker sell model and short-term lows in the market maker buy model. As you can see, we don't get that. We get one here, but we don't get that until we run back up into this PD array, which then gives us our second stage of distribution. Now, for those still watching, I want to give you a quick gem so that you can actually predict when the buying will occur and be able to get in to target these highs. So we have a 15-minute PD array down here, and then as we trade into the 15-minute gap, we have our smart money reversal down here. Then, of course, our low risk sell as we return back into a discount of this swing, return to a discount, low risk sell, distribution phase 1, and then second stage of distribution inside this order block in here. And then look how quickly we run to clear out the original consolidation. So the gem I wanted to give is actually something called mitigation, where we use in a market maker buy model, as this example is, we use the selling which occurred on the sell side of the curve, which is all here. This side of the curve, we want to use this selling and pair it up with the new buying. So where selling occurred, we want to look to buy in them zones. So as you can see here, for example, we have a breaker, and then all this was used to clear out the liquidity inside this PD array. So this area here, if we take it on the sell side of the curve, was used for selling. As you can see here, we broke below it, came back into it before selling off. So if we extend them out in time, that same area that was used to sell into the PD array is now used for buying. So smart money are mitigating their orders and are now buying on this side of the curve. As you can see here, we trade into it. Notice the precision of this. This is important. This isn't a coincidence. How we wick out of the mitigation, the body closes above it and then moves faster, order block, and then runs. And then if we look over here, remember earlier I said in our consolidations we want to see a return to the consolidation. If we extend that box out in time of our consolidation, as you can see, we return into it before selling off more. Now, I told you to use previous selling as new buying. We sold in this area, right? This is where selling occurred. Now we look at the buy side of the curve. Look what happens here. We have the selling turned into new buying to the pip almost on AUD USD 1 minute chart. You can check it for yourselves. This is pretty much to the pip. We get a buy and then price runs quickly above the original consolidation highs. Again, the same thing that happened here. This isn't a coincidence. This is the algorithm. Once you know these keys in price and these signatures in price, you may hear me refer to signatures in price, and this is exactly what I'm talking about. These sort of things where we have a quick move. Look how sensitive this is. Look how quickly we reject off that and then run to the highs. Again, this isn't a coincidence. You pair up selling on the sell side of the curve to our new buying. So if we're here in price, let's say we're here, we saw that selling happened at this return to the original consolidation. We mark up our lines and then we want to see price return here and then buy. If we actually dive inside here, we can see that we consolidate, left a breakaway gap, and then price trades into this down close candle. The down close candle is of course inside our area of previous selling. Can expect a buy from there. If you took a buy from this area with stop loss below the body of this candle, target the highs, that is a 1 to 2, which is perfect. You don't have to catch every single distribution phase of the market maker models. Pick whichever works best for you. Of course, the second stage of distribution will be the quickest, but it also can be the hardest to spot. The low risk stage of distribution isn't actually the lowest risk. In theory, I'd say the first distribution stage is the lowest risk, which is what I trade personally the most. So this here in this return, that would be my buy, or this one here in this order block. So having said that, that pretty much brings us to the end of this video. Now this was quite a deep dive into market maker models, so if you enjoyed, please do leave a like and drop a comment. Follow me on socials below, you will find the links in the description. And yeah, I'll catch you in the next one. Thank you for watching.